The 50-30-20 budget rule. Senator Elizabeth Warren popularized the so-called 50-20-30 budget rule, sometimes labeled the 50-30-20 in her book, All Your Wealth, The Ultimate Life Money Plan. The basic rule to divide after-tax income and allocate it to spend. 50% on needs, 30% on wants, and soaking away 20% to saving. 50% needs. Needs are those bills that you absolutely must pay and are the things necessary for survival. These include rent or mortgage payments, car payments, groceries, insurance, healthcare, minimum debt payment, and utilities. These are your must-haves. The needs category does not include items that are extras such as HBO, Netflix, Starbucks, and dining out. Half of your after-tax income should be all you need to cover your needs and obligations. If you are spending more than that on your needs, you have to either cut down on wants or try to downsize your lifestyle, perhaps to a smaller home or more modest car. Maybe carpooling or taking public transportation to work is a solution, or cooking at home more often. 30% wants. Wants are all the things you spend money on that are not absolutely essential. This includes dinner and movies out, that new handbag, tickets to sporting events, vacations, and the latest electronic gadget, and ultra high-speed internet. Anything in the wants bucket is option for you to boil it down. You can work out at home instead of going to the gym, cook instead of eating out, or watch sports on TV instead of getting tickets to the game. This category also includes those upgrade decisions you make, such as choosing a costlier steak instead of a less expensive hamburger, buying a Mercedes instead of a more economic Honda, or choosing between watching television using an antenna for free or spending money to watch cable TV. Basically, wants are all those little extras you spend money on that make life more enjoyable and entertaining. 20% savings. Finally, try to allocate 20% of your net income to saving and investments. This includes adding money to an emergency fund in the bank saving account, making an IRA contribution to a mutual fund account, and investing in the stock market. You should have at least 3 months of emergency savings on hand in case you lose your job or unforeseen event occurs. After that, focus on retirement and meeting other financial goals down the road. Savings can also include debt repayment. While minimum payments are part of the needs category, any extra payment reduces the principal and future interest owed, so they are savings. The importance of saving. Americans are notorious bad at savings, and the nation has extremely high levels of debt. As of the third quarter of 2020, Americans have $14.9 trillion in debt, which includes $756 billion in credit card debt. The personal savings rate in January 2022 was 6.4%. The 50-20-30 rule is intended to help individuals manage their after-tax income, primarily to have funds on hand for emergencies and savings for retirement. Every household should prioritize creating an emergency fund in case of job losses, unexpected medical expenses, or any other unforeseen monetary cost. If an emergency fund is used, then a household should focus on replenishing it. Savings for retirement is also a critical step as individuals are living longer. Calculating how much you will need for retirement and working towards that goal beginning at a young age will ensure a comfortable retirement. The bottom line. Saving is difficult, and life often throws unexpected expenses at us. By following the 50-20-30 rule, individuals have a plan with how they should manage their after-tax income. If they find their expenditures on wants are more than 20%, they can find ways to reduce those expenses that will help direct funds to more important areas such as emergency money and retirement. Life should be enjoyed, and it is not recommended to live like a Spartan. But having a plan and sticking to it will allow you to cover your expenses, save for retirement, or at the same time doing activities that make you happy.